This is urgent. If you own gold or silver right now, what you're about to hear may change how you hold it. Because behind closed doors, a shift is happening. China has just moved to shut down leveraged retail trading on its gold exchange, while quietly, for 20 months straight, its central bank has been buying tons of physical gold. Poland has bought 82 tons this year alone. And on the other side of the world, physical silver sitting in official vaults has drained by 75%. This is not a coincidence. This is a pattern. And patterns like this have only appeared before major currency shifts in history. So if you own gold or silver, or you're thinking about it, stay with me for the next few minutes, because what happens next could decide whether your wealth is protected or exposed. Welcome back to Currency Arc Insight, the channel serious investors trust for the truth behind the headlines. If this analysis resonates with you, hit subscribe now so you never miss a warning like this one. And tell us in the comments, where are you watching from today? Across the world, a quiet but powerful shift is taking place in the way nations think about wealth. For decades, paper promises ruled the financial system. Currencies, bonds, and digital contracts stood in for real value. But now, in the background, a different story is unfolding. Central banks in the East are buying physical gold at a pace few analysts expected, while in the West, gold reserves are slowly slipping away. Analysts who study these movements describe it as one of the most significant transfers of tangible wealth in modern history. China stands at the center of this story. According to recent trade data, Chinese gold imports climbed to a 2-year high in June, rising for the third month in a row to roughly 173 tons. This came even as global prices fell sharply earlier in the year, a drop that many investors saw as a warning sign, but which Chinese buyers treated as an opportunity. Analysts note that commercial banks in China have been steadily building their gold inventories, not simply to profit from trading, but to prepare for something larger. These reserves are being used to support retail demand for physical bullion and to create a financial cushion in case of sudden economic shocks. Xi Jiwu, an analyst covering the futures market, explained that investors have been buying on every dip, while banks have used the opportunity to fill import quotas and strengthen their physical holdings. At the same time, the People's Bank of China has continued its own buying spree. In June alone, it added another 15 tons of gold to its reserves, marking 20 consecutive months of net purchases. Poland, too, has joined this wave, adding 82 tons of gold to its national reserves so far this year. These are not small symbolic purchases. They represent a deliberate strategy by nations seeking to reduce their dependence on paper currency and rebuild their financial foundations around something they can physically hold. What makes this story even more compelling is the question of how much gold China actually holds. Officially, the People's Bank of China reports around 2,300 tons in its reserves, but several independent researchers, who have studied China's trade flows and production data for years, believe the real number could be significantly higher. They argue that the Chinese government, through various channels beyond the central bank itself, controls a far larger stockpile than official figures suggest. This secrecy is not unusual for a nation preparing for a major shift in the global financial order. Interestingly, China is not only the world's largest importer of gold, but also its largest producer, mining close to 400 tons annually. Even with this massive domestic output, demand from jewelry makers, investors, and the central bank itself continues to outpace supply, forcing China to import even more from international markets. For those who study financial history, this pattern feels familiar. Nations preparing for a change in monetary power often begin by quietly accumulating hard assets, long before the wider public understands what is happening. Analysts point out that this slow but steady accumulation is not just about profit. It is being framed as one of the clearest signs yet that global confidence in paper-based currency systems is eroding. Meanwhile, everyday citizens in China are being encouraged by their own culture and government to hold physical gold as a form of personal security. Analysts often describe this as being deeply rooted in Chinese tradition, where gold has long been seen as true, lasting wealth passed down through generations. This cultural mindset now aligns perfectly with the government's broader economic strategy, creating a powerful combination of national policy and public behavior working toward the same goal. As this quiet transformation continues, one question begins to take shape in the minds of serious investors. If nations and entire populations are moving steadily toward gold while paper currencies face mounting pressure, what does this mean for those still holding on to assets built on promises rather than physical value? This is the question that sets the stage for everything that follows. While gold quietly moves from west to east, another crisis has been building in the energy markets, one that few investors are watching closely enough. Tensions in the Strait of Hormuz have escalated into open conflict, with attacks on shipping, triggering retaliatory strikes on power stations and infrastructure. This ongoing standoff has pushed oil prices toward $95 a barrel, a level that carries consequences far beyond the energy sector alone. What makes this situation more dangerous is the state of global oil inventories. For months, stockpiles that once kept prices in check have been steadily drawn down. Analysts warn that if the conflict continues into the winter season, when demand for energy naturally rises, the world could face a severe supply shortage. Depleted reserves combined with an unresolved conflict create the conditions for a sharp and sudden spike in energy costs, one that would ripple through every corner of the global economy. Rising energy prices rarely stay contained. They move quickly into transportation, manufacturing, and food production, pushing overall inflation higher. This is exactly what analysts are now observing. As fuel costs climb, inflationary pressure builds, and bond markets have already begun to react. Investors, sensing that central banks will be forced to raise interest rates in response to rising prices, have started selling off government bonds. This sell-off pushes yields higher and adds even more strain to an already fragile financial system. Central banks face a difficult choice in moments like this. Raising interest rates can help slow inflation, but it also risks slowing economic growth at a time when the world can least afford it. Analysts describe this as an old economic playbook, one that central banks continue to rely on despite its costs. Every sign of rising inflation brings renewed expectations that interest rates will climb further, adding another layer of uncertainty for businesses and investors trying to plan ahead. While energy and bond markets show visible stress, a quieter and perhaps more telling crisis is unfolding in the silver market. Physical silver held in official vaults, tracked through major commodity exchanges, has fallen by 75% from its peak levels just a few years earlier. This is not a small shift. It reflects a real and growing shortage of physical metal available for delivery. The reason behind this drain is not simply investment demand. Silver has become an essential material for modern industry, particularly in solar panel manufacturing and the expansion of electrical grids around the world. As countries invest heavily in renewable energy and infrastructure, industrial demand for silver has surged, pulling supply away from investment markets and into factories and production lines. Some manufacturers have begun searching for alternative materials to reduce their dependence on silver, but for now, demand continues to outpace what mines and recycling can provide. This creates an unusual and important dynamic. Unlike gold, which is primarily held as a store of value, silver sits at the intersection of investment demand and industrial necessity. When both forces pull in the same direction at the same time, the pressure on available physical supply becomes intense. Analysts argue that this growing gap between paper contracts and real deliverable metal cannot continue indefinitely without consequences for pricing. Taken together, these developments tell a larger story. Energy markets are under strain from geopolitical conflict and shrinking reserves. Inflation is rising, forcing central banks into difficult decisions. Bond markets are already reacting to what may come next. And beneath all of this, physical silver is quietly disappearing from official vaults at a pace that few outside the industry are tracking closely. For investors trying to understand where the global economy is heading, these are not separate, unrelated events. They are pieces of the same picture, each one adding pressure to a financial system already showing signs of strain. As paper markets struggle to keep pace with what is happening in the real world, the gap between promises and physical reality continues to widen, setting the stage for what many analysts believe could be a significant turning point. As pressure builds across energy, bond, and metals markets, China has quietly taken a step that few outside financial circles fully understand. Beginning this week, the country is terminating leveraged trading of gold and silver for retail investors through the Shanghai Gold Exchange. On the surface, this may sound like a minor regulatory adjustment. In reality, analysts believe it signals something far more significant about where China intends to take its financial system. Under the old system, smaller and medium-sized investors could trade gold and silver futures with borrowed money, amplifying both their gains and their losses. This kind of leveraged trading often creates sharp price swings, especially during moments of panic or excitement. When markets rise quickly, leverage draws in speculators chasing profits. When markets fall, that same leverage forces sudden liquidations, deepening the decline. By removing this option for retail accounts, Chinese regulators are effectively pulling a major source of volatility out of their domestic market. This does not mean ordinary investors are banned from trading gold and silver altogether. Analysts who understand the details of Chinese financial policy point out that trading is simply shifting toward forward contracts on the Shanghai Futures Exchange and the Hong Kong bullion market. The distinction matters. Rather than closing the door on participation, China appears to be redirecting activity toward markets it considers more stable and better suited to its long-term goals. Those long-term goals appear increasingly clear. China is positioning physical gold as a foundational reserve asset, not just for its central bank, but for its broader financial architecture. By strengthening both the Shanghai Gold Exchange and the newer Hong Kong bullion market, Authorities are working to build parallel systems capable of supporting a much larger role for physical gold in the years ahead. This is not the behavior of a nation treating gold as a speculative commodity. It is the behavior of a nation preparing its financial infrastructure for a different kind of monetary future. Meanwhile, gold prices themselves tell their own story of volatility and recovery. After reaching a peak above $5,500 earlier in the year, gold fell sharply, dropping below $4,000 at one point. It has since begun to recover, trading around $4,100, though analysts caution it is too early to call this a confirmed turning point. Silver has followed an even more dramatic path, falling from a peak near $121 down to around $59, a decline that has tested the patience of many investors. Against this backdrop of price swings, major financial institutions are beginning to take notice. UBS, one of the world's largest wealth management firms, recently added a gold mining company called West Gold to its recommended buy list. Moves like this from major institutions often carry weight beyond the specific company involved. They can signal a broader shift in how professional investors view the sector as a whole, particularly at a time when prices remain well below their recent highs. Taken together, these developments paint a picture of a market in transition. China is reshaping how its citizens and institutions interact with gold and silver, steering activity away from speculative leverage and toward more structured, stable channels. At the same time, prices are working through a period of sharp correction and early recovery, testing the conviction of investors who bought near the highs. Major institutions, rather than stepping back, appear to be positioning themselves for what may come next. For those trying to understand the significance of these regulatory changes, the key lies in recognizing what China is not doing. It is not discouraging its population from holding physical gold. It is not stepping back from its own accumulation strategy. Instead, it is refining the system around these activities, removing sources of instability while reinforcing the structures that support long-term physical ownership. As these changes take hold, many analysts believe the groundwork is being laid for a financial environment where physical metal, not paper contracts, ultimately determines value. As all these threads come together, energy, inflation, monetary policy, and the physical scarcity of precious metals, a single question begins to dominate the thinking of serious analysts and investors alike. What happens when paper markets can no longer keep pace with what is actually happening in the physical world? For years, the price of gold and silver has been determined largely through paper contracts traded on futures exchanges far removed from the actual movement of physical metal. These contracts allowed for enormous trading volumes, often many times greater than the amount of real gold and silver that could ever be delivered. This system worked as long as most participants were content to settle in cash rather than demand physical delivery. But that assumption is now being tested. As central banks in the East continue to accumulate physical gold at a steady and deliberate pace, and as industrial demand drains silver from vaults faster than mines can replace it, the gap between paper promises and physical reality grows wider. Analysts describe this as an unsustainable imbalance. At some point, they argue, the paper market's ability to suppress or dictate prices independent of physical supply will reach its limit. China's regulatory shift away from leveraged retail trading may be an early signal of this transition. By reducing speculative activity in its domestic gold market, China is removing one of the mechanisms that has historically allowed paper trading to influence prices without corresponding physical backing. Combined with the country's own aggressive accumulation of gold, both officially and, according to many researchers, well beyond what is publicly reported, a picture emerges of a nation preparing for a world in which physical possession, not paper claims, determines financial strength. This shift does not happen in isolation. It arrives at a moment when energy markets remain under pressure from ongoing conflict, when inflation expectations are pushing bond yields higher, and when central banks face the difficult task of managing interest rates without triggering deeper economic strain. Each of these pressures adds weight to the same underlying trend, a gradual but persistent move away from confidence in purely paper-based financial systems. For the business community and for individual investors alike, the implications are significant. Analysts note that those who understand this shift early are the ones best positioned to protect their wealth as it unfolds. Waiting until the transition becomes obvious to everyone often means acting after much of the opportunity has already passed. History has shown that major shifts in monetary confidence tend to move slowly at first, then rapidly, once broader awareness catches up with what informed observers have already recognized. It is worth remembering that none of this unfolds overnight. Gold's recovery from its recent lows remains uncertain, and silver continues to trade well below its previous highs. Markets rarely move in straight lines, and short-term volatility is likely to continue as these larger forces work themselves out. But for those willing to look past daily price swings and focus on the underlying structural changes, the direction of travel appears increasingly clear. Central banks are buying. Industrial demand is draining physical supply. Regulatory systems are being redesigned to support long-term ownership over short-term speculation. And geopolitical conflict continues to add pressure to an already strained financial system. Individually, each of these developments might seem manageable. Together, they form a pattern that serious analysts believe cannot be ignored. As this story continues to develop in the months ahead, one thing seems increasingly certain. The world is not simply experiencing another cycle of market volatility. It is witnessing the early stages of a deeper structural shift in how wealth is measured, stored, and protected. For those paying close attention, the message is clear. The foundations of the financial system are changing, and those who prepare early will be the ones best positioned when the shift becomes impossible to ignore.